Jason Trennett joins us now from Strategas. Jason, good to see you. Thanks so much for joining us. I mean, it's amazing how quickly those pullbacks are in the rearview mirror. Do you think that the second half of the year from here will be positive?
I think it may be, but I think what we've seen over the last couple of weeks is probably more emblematic of what we're going to see in the second half of the year, which is to say that I think it's going to be a lot more volatile. We're well into the second year of the bull market off of the March 23rd low in 2020. Second years are always more difficult, and I think in my opinion, it's going to be more difficult because we're going to start paying for some of the massive amounts of stimulus, monetary and fiscal stimulus in other ways. So far, it's been kind of a free pass. We'll see in terms of 10-year Treasury yields, but my bias is to think that they're going to move higher, and that's going to change the equation for stocks and stock pickers.
So the catalyst then for some more of the potential pain or volatility is what? Is Fed tightening, or is it just yields moving up independently of that?
Well, I think, listen, I don't even think that's necessary. I think just in terms of what you're going to get from real growth or even nominal GDP growth. When I started, this seems so hopelessly Victorian now, but people would use nominal GDP growth as kind of what you would use as your answer for 10-year Treasury yields. Obviously, we're a long way away from that by almost however you slice it. We're a long way away from that. So I think rates can rise without even the Fed tightening. I think also, you're going to have I think all policymakers are going to have a harder time stepping away from the table of accommodation than they perceive because of things that you've seen just over the last week. There are going to be all sorts of concerns about whether it's employment or whether it's a Delta variant or health issues. There are going to be some very difficult political choices, I think, even for the Fed, that have to be made in the second half of the year.
So having said all that, Jason, you like energy, financials, materials, and industrials, which is currently what's working in the market today, and basically had been working until Treasury yields started falling, and then they got hit the hardest.
That's right.
So you haven't lost faith there in some of those cyclical groups? Sarah, I haven't, and this is one of these. It doesn't matter why you're wrong.
I think you're when you're wrong, you're wrong. This is one of these issues where I thought higher inflation would lead to higher 10-year Treasury yields, and that was our general feeling at Strategas, and we're still largely of the view that inflation is going to be stickier. Obviously, the Treasury market is on a different page. And we have to respect the markets. We have to make sure that we're not whistling past the graveyard. My own opinion is that in time, Treasury yields will reflect what we believe will be stickier inflation. Having said that, I think what we saw earlier this week or last couple of weeks is either a fear that we may make a policy error by maybe tightening too soon, or that there's another spike in the Delta variant or something else that's happening, or geopolitical event. And so I would say commodities and stocks are largely on the same page. They're kind of telling you the same thing for the most part. Treasury yields tend to be a little bit of the outlier, but you still have to respect it.
Shepard Smith here. Thanks for watching CNBC on YouTube.